All right, diving right in today, we're taking a closer look at Five Below's fourth quarter 2024 earnings call. This one's got a lot to unpack, so let's get to it. What's the big picture here, setting us up for what this might mean as we head into 2025?
Yeah, definitely. If we zoom out and look at the full year, Five Below pulled in sales just under $3.9 billion, which, sounds pretty impressive on the surface.
Yeah, it does.
But when you start to dig into the details, specifically comparable sales, which really tell you how their existing stores are performing, that's where things get a bit more interesting.
Interesting how?
Well, their comparable sales were actually down by 2.7% for the year.
Mm-hmm.
Now, their adjusted earnings per share, that came in at $5.04 for the year. So they're still making money, just not necessarily growing at the rate some might have hoped for.
Makes sense.
One thing that really jumps out is their growth in terms of new stores.
Oh, yeah, they opened a ton, didn't they?
A record number, in fact. They opened 228 new stores across 39 states, including their very first store in Wyoming. That brought their total store count to a whopping 1,771 by the end of the year.
So they're definitely expanding their footprint aggressively.
Absolutely. Now, if we narrow our focus down to just the fourth quarter, we see a 7.8% increase in total sales, hitting $1.39 billion, up from $1.29 billion the year before. But again, those comparable sales are telling a different story.
Yeah, I was going to say, those didn't seem to be doing as well, did they?
They dipped again, down by 3% this time. And the company pointed to a couple of reasons for that. A 1.9% decrease in the number of transactions, basically fewer people coming into the stores, and a 1% decrease in the average amount each customer spent. They also mentioned there were 5 fewer holiday shopping days in the quarter compared to the previous year.
Yeah, that makes sense. That would definitely impact their numbers.
And finally, their adjusted earnings per share for the fourth quarter was $3.48, which was actually down slightly from the $3.50 they reported in the same quarter last year.
So all in all, it sounds like a bit of a mixed bag for Five Below in 2024, right? Overall sales are up thanks in part to those new store openings, but the performance of their existing stores seems to be lagging a bit.
You hit the nail on the head. They actually described it as a year with 2 distinct halves.
Oh, what do you mean by that?
Well, they said the first half of the year didn't quite meet their initial expectations, so somewhere around mid-year, they hit the reset button and initiated what they're calling a strategic reset.
Interesting.
This reset was really focused on 3 key areas: enhancing their product offerings, emphasizing the value they provide to customers, and improving the overall shopping experience in their stores. And it seems like those efforts did have a positive impact, because in the second half of the year, both their sales and adjusted earnings per share exceeded the upper end of their projections.
So they managed to turn things around.
Yeah, to some extent, but they were pretty transparent about the fact that they probably missed out on some potential sales due to adjustments they made to their orders earlier in the year when demand was softer. So even though they course corrected, there were lingering effects from those initial decisions.
Makes sense. So the second half looked better, but those earlier challenges still had consequences.
Precisely.
Now let's talk about profitability. What was happening with their gross margin, which is essentially how much profit they make on each dollar of sales after accounting for the cost of the goods themselves?
Yeah, that's a crucial metric for any retailer.
Absolutely.
In the fourth quarter, their adjusted gross margin actually decreased by about 60 basis points, ending up at 40.5%.
Okay, so what drove that decline?
Well, the primary culprit was something called fixed cost deleverage, which is a bit of a mouthful, but it basically means that when your sales in existing stores go down, but you still have all those fixed costs like rent, utilities, and those types of things that don't change much regardless of sales volume, those fixed costs end up eating into a larger chunk of each dollar of revenue.
That makes sense.
And then the timing of when they had to pay certain product costs also played a role in that margin decrease.
Okay, so it was a combination of factors.
Yeah, but it wasn't all bad news on the margin front. The decrease was partly offset by lower inventory shrink, meaning they lost less product due to theft, damage, or other issues.
Oh, that's good.
Yeah, and that improvement in shrink was partly because they were comparing against a larger reserve they had to take the previous year, and they also saw a slightly lower shrink rate in stores that had their inventories counted in January.
Okay, so they're making some progress on that front.
It seems so, and looking at the full year, their adjusted gross margin decreased by a smaller amount, about 10 basis points, to end up at 35.6%.
Okay, so the takeaway there is that while they're managing some of those cost issues like shrink, that decline in sales at existing stores is definitely putting a damper on their profitability.
You got it.
Okay, so that's gross margin. What about their SG&A expenses, those selling general and administrative costs? How did those look?
Right, so those are the costs associated with running the business as a whole, not just the direct cost of the goods they sell.
Exactly.
In the fourth quarter, their adjusted SG&A expenses increased by about 110 basis points, reaching 22.3% of their total sales.
Okay, and what were the main drivers behind that increase?
Again, a big factor was that fixed cost deleverage from the negative comparable sales, basically the same story as with the gross margin.
Gotcha.
They also had higher store wages and increased the number of hours they had store employees working.
Yeah, I've heard that labor costs have been a challenge for a lot of retailers lately.
Absolutely. And these increases in SG&A were partially offset by lower expenses related to incentive compensation. So that helped a little bit.
Okay.
And for the full year, their adjusted SG&A increased by an even larger 140 basis points to 26.4% of sales. And the reasons behind that were pretty much the same as what we saw in the fourth quarter.
So it's pretty clear that those challenges with comparable sales are impacting not only their gross profit, but also their overall operating expenses as a percentage of their revenue.
You nailed it.
Okay, shifting gears a bit, let's talk about inventory. That's always a critical area for retailers to manage effectively. What did Five Below's inventory levels look like at the end of the year?
Yeah, great question. So their inventory stood at $659.5 million at year end, which is up from $584.6 million at the end of the previous year.
So their inventory levels are increasing?
On the surface, yes, but it's important to dig a little deeper. When you look at the average inventory per store, that actually decreased by about 2%.
Interesting. How did that happen if the overall inventory amount went up?
Well, a big part of that decrease is due to a $20.5 million write-off of inventory they talked about back in their third quarter earnings call.
Oh, right.
So while the total dollar amount of inventory is higher, they've taken steps to clear out some of those slower moving or potentially obsolete goods.
So they're actively trying to optimize their inventory.
Exactly. And on average, each store is carrying a bit less inventory than they were the year before. But the company did mention that while they've made progress in improving the overall health of their inventory, there are still some specific product categories where they need to replenish their stock.
Okay, so they're not quite where they want to be yet in terms of having the right products in the right amounts.
It sounds that way.
Now, let's talk about tariffs. Those have been a big concern for a lot of companies that import goods, and I imagine Five Below is no exception. What do they have to say about how tariffs are affecting them?
This is definitely a key point to pay attention to. The company talked about the potentially significant impact of the recently announced tariffs on goods imported from China. And, China is a major source of their products, accounting for about 60% of their cost of goods.
Wow, so that's a pretty big exposure.
It is, but they're not just sitting back and taking it. They're pursuing several different strategies to mitigate the impact of these tariffs.
Like what?
Well, first, they're working closely with their vendors to see if there are ways to absorb some of those increased costs without passing them along to consumers.
Okay.
They're also planning to make some selective price adjustments, though they emphasize that these will primarily be within their core price range of $1 to $5.
So they're trying to minimize price increases as much as possible.
Yeah, it seems like they're very aware of the importance of maintaining their value proposition.
Makes sense.
Another strategy they're pursuing is diversifying their sourcing, basically trying to find suppliers in other countries besides China.
Oh, interesting.
Yeah, they specifically mentioned leveraging their office in India as part of this effort.
Okay.
And finally, they're really emphasizing the importance of bringing new and exciting products to their shelves. The idea being that if they offer products that customers really want, they might be less sensitive to small price increases.
Makes sense. So they're trying to address these tariffs from multiple angles.
Exactly. And it's important to note that their financial guidance for the upcoming year already factors in an estimated negative impact on their profit margins from these tariffs, even after accounting for the potential benefits of their mitigation efforts.
So they're already baking in some pain from those tariffs.
Yeah, they're projecting that tariffs will reduce their gross margin by about 100 basis points for the full year 2025, and they expect that impact to be even more pronounced in the second half of the year.
Okay, so tariffs are a clear headwind for them, and how successful they are in implementing these mitigation strategies will have a big impact on their bottom line.
Agreed.
Now, let's talk about their guidance for the rest of 2025. What are they expecting in terms of overall performance?
All right, so for the full year 2025, Five Below is projecting sales to be somewhere between $4.21 billion and $4.33 billion. They expect comparable sales to be somewhere between flat and a positive 3%.
Okay, so they're not expecting huge growth in same-store sales, but at least they're not projecting a decline.
Yeah, that's a fair assessment. And their adjusted operating margin is anticipated to be around 7.3%, which is a decrease of about 180 basis points from the previous year.
Oof, that's a pretty significant drop.
It is. And remember, they said over half of that decline is directly attributable to the impact of those tariffs.
Right.
Their adjusted diluted earnings per share are projected to fall between $4.10 and $4.72 for the full year.
Okay, so a bit of a wide range there, but understandable given all the uncertainties.
Absolutely. And they're also planning to open roughly 150 new stores in 2025.
So continued aggressive expansion.
Yep. Now, if we zero in on just the first quarter of 2025, they expect sales to be between $905 million and $925 million, with comparable sales projected to be anywhere from flat to a positive 2%.
Okay.
Their adjusted operating margin for the first quarter is anticipated to be around 4%, which is down from 4.7% in the same quarter last year.
Okay, so why the decline in the first quarter?
They're attributing that mainly to higher SG&A expenses, driven by those investments in store labor and depreciation. They do expect to see some offsetting benefit from an increase in their gross margin thanks to lower reserves on older inventory, but it won't be enough to fully counteract a higher SG&A.
Gotcha.
And their adjusted diluted earnings per share for the first quarter are expected to be between 50 cents and 61 cents.
So all in all, their guidance reflects both optimism about overall sales growth, which will be fueled primarily by those new store openings, but also a realistic acknowledgement of the pressure on their profitability, especially from those tariffs.
Exactly.
Now, Five Below has a new CEO, and it sounds like he's stepping into a pretty challenging environment, but also one with some interesting opportunities. What's the core of his strategic focus?
Yeah, he's definitely got his work cut out for him, but he's laid out a pretty clear vision for moving the company forward, and at the heart of it is a renewed focus on their core customer, which is kids and their parents.
Okay, so back to basics in a way.
In a sense, yes, but he's also highlighted some key adjustments and initiatives to make sure they're staying relevant in a rapidly evolving retail landscape.
Such as?
Well, one of the key things he talked about was curating a more focused selection of what they're calling fewer, bigger, and better key items. Basically, they want to make sure they're offering a more impactful assortment of products that really resonate with their target audience.
So less clutter, more hits?
Yeah, something like that.
Okay, what else?
Another focus is simplifying their pricing structure with a greater emphasis on whole dollar price points between $1 and $5.
Makes sense. Keep it simple and appealing.
Right. And then they also want to enhance the perceived value of products priced above $5, those in their 5 Beyond section. They need to make sure customers feel like they're getting their money's worth even when they venture above that $5 threshold.
Yeah, that's a good point.
And then they're also going to be more actively promoting their brand through marketing efforts. They recently hired a new chief marketing officer to lead that charge.
So they're stepping up their marketing game.
It seems so. And finally, they're also making a push to develop their omni-channel capabilities. Basically, they want to be able to reach customers however they prefer to shop, whether that's in-store, online, or through some combination of both.
So a more holistic approach to engaging with their customers.
Exactly. So the takeaway here is that they're not abandoning the fundamentals that have made them successful in the past, but they're also making adjustments to adapt to the changing retail landscape and better resonate with their target customer.
Okay, that makes sense. Now, store growth has always been a big part of the Five Below story. What are their plans for expanding their footprint moving forward?
They're definitely not slowing down on that front. They believe they have a long-term opportunity to grow to approximately 3,500 stores.
Wow, so a lot of room for expansion still.
Yeah, they see significant potential, and their strategy involves a combination of increasing their density in existing markets, basically adding more stores in areas where they're already present, and entering new markets like the Pacific Northwest.
So a balanced approach.
Yeah, and they emphasize that they're going to be very disciplined when it comes to selecting new store locations. They're really focused on making sure each new store is likely to generate a solid return on their investment.
Makes sense. No point in just expanding for the sake of expanding.
Right, and they're also going to continue the pause on broader store remodel programs that they implemented in 2024. Their main priority for capital expenditures will be on opening those new stores.
So they're prioritizing new store openings over refurbishing existing ones.
For now, yes.
Okay, now in the current economic climate, which is, let's face it, a bit uncertain, how is Five Below thinking about the health of their core consumer? Are they seeing any shifts in spending patterns that give them cause for concern?
That's a good question. And what's interesting is that they said they haven't really seen any significant difference in how their customers are spending between essential, consumable items and more discretionary purchases.
So no major signs of a pullback in spending yet.
Not that they've noticed. And they also mentioned that their financial guidance for the coming year takes into account a range of potential economic scenarios. So they're aware of the uncertainties out there, and they've tried to factor those into their projections.
So they're being cautious but not overly pessimistic.
Yeah, I think that's a fairer way to put it.
Now, Five Below's Five Beyond section, where they offer items priced above their traditional $5 limit, has been an interesting evolution for them. What's their current perspective on that part of their business?
It's definitely been a bit of a learning curve for them. They acknowledge that historically, the Five Beyond section has been the least productive area within their stores in terms of sales per square foot.
So not really living up to its potential?
Not initially, no, but they now see it as a significant opportunity. They view it as a platform to showcase what they call big wow items, those products that can really capture customers' attention and drive impulse purchases.
So more of a destination for those seeking something special?
Yeah, that's the idea. And they also see it as giving them greater flexibility in terms of the types of products and categories they can offer.
So more freedom to experiment and potentially appeal to a wider range of customers.
Exactly. But they stress that their main focus remains on ensuring they're providing strong value and relevance for all products in the Five Beyond section, both those priced below and above $5. They need to make sure customers feel like they're getting a good deal, regardless of the price point.
Makes sense. So they're committed to making Five Beyond a more integral and successful part of the overall Five Below experience.
It seems that way.
Okay, last but not least, let's talk about inventory shrink. It's a persistent challenge for a lot of retailers, and Five Below is no stranger to it. What's the latest on that front?
Yeah, shrink is a tough one. It's hard to completely eliminate, but Five Below is definitely working to control it. Right now, the rate at which they're accruing for shrink is about 100 basis points higher than it was back in 2019.
So they're experiencing higher shrink now than they were a few years ago.
Yeah, unfortunately, but they did mention that recent physical inventory counts in many of their stores have actually shown improved shrink rates compared to earlier periods. And they think that might be partly due to the investments they've been making in store labor.
So potentially having more employees on the floor to deter theft and keep a closer eye on things.
Yeah, that's the thought. But even with those encouraging signs, the company wants to see sustained improvement over a longer period before they consider adjusting their shrink accrual rates in their financial guidance.
So they're not getting ahead of themselves. They want to be sure those improvements are lasting.
Exactly.
Okay, great. Well, that was a very thorough look at Five Below's fourth quarter 2024 earnings call. Thanks for walking us through all the key details.
My pleasure.
Now, before we wrap up, it's time for our This Is Not Financial Advice segment, where we throw out a potentially outrageous but also plausible trade idea inspired by what we've learned from this earnings call.
All right, let's hear it.
So you know how Five Below is expecting some margin compression in the back half of 2025 due to those tariffs?
Yep.
And they're also planning to open a bunch of new stores, and they're really emphasizing that core value proposition, those products priced between $1 and $5.
Right.
Well, what if you took a more nuanced approach and looked at a pairs trade within the discount retail sector?
Oh, I like where you're going with this.
Specifically, consider shorting shares of a discount retailer that isn't planning to open as many new stores as Five Below and isn't facing the same level of direct tariff exposure on their core product lines. And at the same time, you take a long position in Five Below, but not immediately. You wait until we see some evidence in their early 2025 results that their mitigation strategies for those tariffs are working better than the market currently expects.
So basically, you're betting that the market might overreact to Five Below's margin concerns in the short term, creating a buying opportunity if they can demonstrate resilience, while simultaneously betting against a less growth-oriented competitor that might seem relatively safe but could underperform if Five Below's strategic reset and expansion gain traction.
Exactly. It's a bit of a gamble, for sure, but that's what makes it outrageous.
And potentially quite profitable if it plays out the way you envision it.
Right, but to be absolutely clear, this is just a thought experiment, not a recommendation. Please don't take this as financial advice.
Agreed.
All right, that wraps up our deep dive into the Five Below fourth quarter 2024 earnings call. We've covered their financial performance, the challenges and opportunities they're facing, and their strategic priorities moving forward. Hopefully, this discussion has provided some valuable insights and given you some food for thought as you consider your own investment decisions.
And remember, this analysis is for informational purposes only and not financial advice.
Thanks for joining us.